Most veterans assume the VA loan is always the better deal, and honestly, for a long time, I kind of did too. But after running the numbers on hundreds of files, I can tell you there are real situations where conventional financing actually beats your VA benefit. And if you don't know what those situations are, you could leave thousands of dollars on the table without even realizing it. Today, I'm going to walk you through a head-to-head comparison across 5 dimensions: down payment, mortgage insurance, interest rates, the funding fee, and flexibility. And by the end, you'll know exactly which loan wins in your specific scenario. Quick note, if you're a veteran trying to decide which loan type makes the most sense for your specific situation, that's exactly what I help with one free strategy call. Let's run your numbers both ways and find the right answer for you. Most lenders give you a rate. I'm going to give you a strategy, and today is no different. The link is in the description below. Okay, round 1, down payment. This one seems obvious. VA loans allow you to purchase without a down payment. Conventional loans require a down payment of at least 3%. So the VA wins by default, right? Well, hold on. I actually had a client last year that was a retired E7. Solid pension, he'd been saving for years, had over 20% to put down. And when we ran his numbers both ways, the conventional loan actually came out cheaper over the life of the loan. I'll explain exactly why that happened when we get to round 4, because the funding fee is where this whole thing flips in ways most people don't actually expect. But for now, understand this. If you have limited cash to close, VA is a no-brainer on down payment. If you've got significant savings, keep an open mind because the math changes. Okay, round 2, mortgage insurance. And this is where most people think the VA wins, and honestly, they're mostly right. Conventional loans with less than 20% down require private mortgage insurance, which is a monthly fee that protects the lender, not you. And in 2026, monthly PMI can add roughly $150 to $300 to your payment. That's real money that's just evaporating every single month. VA loans, no monthly mortgage insurance, period. Instead, you pay a one-time funding fee. And for first-time users, that's generally 2.15% of the loan amount. So it's a one-time cost versus an ongoing monthly cost. And here's what most people miss. PMI falls off once you reach 20% home equity. So if you're putting, say, 15% down on a conventional loan, that PMI might only last a couple of years before it drops off automatically. The funding fee, on the other hand, is baked into your loan for 30 years if you finance it. So the question isn't which has insurance, it's how long are you paying and how much total? Let me ask you something. Do you know whether you might be exempt from the funding fee entirely? Because if you have a 10% or higher VA disability rating, the funding fee is waived entirely. About 1/3 of all VA loan borrowers are exempt. If that's you, VA wins this round by a landslide, and honestly, it's not even close. Round 3, interest rates. And okay, what I'm about to explain is the part that changes everything. If you've been following along, this is where it all clicks, because the federal government guarantees a portion of every VA loan. Lenders view them as lower risk, and the VA loan rates are consistently averaging 1/4 to 0.5% lower than conventional rates. That might not sound like much, but over 30 years, that difference adds up to tens of thousands of dollars in interest. I actually ran this for a borrower last month, and it blew my mind. The rate difference alone saved him more over the life of his loan than the entire funding fee cost him. That is the kind of math that changes your decision. But here's the nuance. For a strong borrower with excellent credit and substantial savings, conventional loans can be competitive. And if you've got a 780 credit score and significant money down, conventional lenders are going to fight for your business, and that rate gap shrinks. So the rate advantage is real, but it's not universal. It depends on your profile. If you're a veteran trying to decide which loan type makes the most sense for your specific situation, that's exactly what I help with on a free strategy call. Let's run your numbers both ways and find the right answer for you. The link is right below this video. Round 4. And this is the one I promised would flip the script. The VA funding fee. So for first-time use with no money down, first-time VA loan users pay a 2.15% VA funding fee. But here's where it gets really interesting. Subsequent users pay a 3.3% funding fee with no down payment. So let that sink in. If you've used your VA benefit before and you're buying again, that fee jumps significantly. I had a borrower who had already used his VA loan on his first home. He was buying his second property, had solid equity from his first sale, and when I showed him the 3.3% funding fee versus putting 20% down on a conventional loan with zero PMI and a competitive rate, the conventional loan saved him money. Not a little, meaningfully. Now, if you put down 5% or more, the fee does drop to 1.5%. And if you put down 10% or more, it goes down to 1.25% for both first-time and repeat users. So there's a middle ground here too. Some veterans put a small amount down on their VA loan just to reduce their funding fee, and that can be a really smart move. The key takeaway isn't that the funding fee isn't one number, it's a sliding scale. And where you land on it dramatically changes which loan wins. Now, round 5, flexibility. And honestly, I think most people overlook this one, but it matters a lot for certain veterans. You see, VA loans are for primary residences only. If you're buying a vacation home or an investment property, a conventional loan is the way to go. I work with a lot of veterans who are building rental portfolios. And here's the thing, your VA benefit is incredibly valuable for the home you live in, but it can't help you buy that duplex across town that you want to rent out unless you plan to live in one of the units. VA can be used on 1 to 4 units if you live in one of the units, which is a powerful house hacking strategy. But for a straight investment property, conventional is the only option. There's also the assumability angle that most people never think about. VA loans are assumable, and if you sell your home in the future, your buyer can take over your mortgage if they meet specific qualifications. In a high rate environment, that's a massive selling advantage that makes your home more attractive to buyers. Now, conventional loans don't have that feature. So when you're thinking flexibility, it's not just about today's purchase. It's about your 5 and 10-year plan. So here's the bottom line. If you're buying your primary home with limited cash, especially on your first use, and particularly if you have any VA disability rating, the VA loan is almost certainly the right call. No down payment, no mortgage insurance, lower rates, and assumability make it incredibly powerful. But if you've got significant cash for a down payment, if you're on your subsequent use and facing that higher funding fee, if you're buying an investment property, or if you're a strong borrower with excellent credit who can eliminate PMI entirely, conventional deserves a serious look. The answer isn't always VA, and it isn't always conventional. A real strategist runs the numbers both ways before making a recommendation to you. If you're a veteran trying to decide which loan type makes the most specific sense for your situation, that's exactly what I help with on a free strategy call. Let's run your numbers both ways and find the right answer for you. Link is in the description below. And if this helped you see your situation differently, hit subscribe. I've got more content coming that's going to save you real money on one of the biggest financial decisions of your life. I'll see you on the next one.